So I'm going to tell you how much income you can realistically get from a £100,000 pension pot, but I'm also going to tell you how to boost that. But I'm also going to tell you the context you need around that. So how much income you're likely to need in retirement as well. So in terms of retirement, the Retirement Living Standard did some research and they stated that if you wanted a minimum type of retirement, which is really covering the essentials like groceries and bills with a bit extra for a few meals out each month and a UK holiday once a year, you'd need £14,400 a year for a single person or £22,400 for a couple. So that's more of a making ends meet type of retirement. So that will give context to the numbers I talk about later in this piece about how much income you can get from a £100,000 pension pot. If you want a more moderate and financially secure retirement, which would include 2-week holidays in Europe each year, the occasional new household appliance, be able to pursue your hobbies, maybe gardening or photography, then the research showed that you'd need £31,300 a year if you're a single person or £43,100 a year if you are a couple. But what about a comfortable retirement? So this is a more luxurious lifestyle with regular holidays abroad, a new car every few years, and the ability to enjoy leisure activities like golf or theatre trips without worrying about the cost. Then this financially secure and fulfilling retirement would be £43,100 a year if you're a single person or £59,000 a year if you are a couple. Now, that gives you an idea of how much money you'd probably need from that pension pot of yours. And we're talking about defined contribution pension pots here. But don't forget you've got a state pension as well. So the full state pension for the 2024-25 tax year is £11,502.40 or £221.20 a week. And this applies to people who've reached state pension age on or after April the 6th, 2016. And typically you need 35 years of national insurance contributions to be getting the full state pension. And you need at least 10 years of qualifying national insurance contributions to get anything at all. So this is important and you can have gaps in your record. I'll come on to that later in this piece about how you can boost your state pension. But make sure you go and check what sort of state pension you will get. You can actually do that on the official website. We'll put a link in the notes to where you can get a state pension forecast. So make sure you go and do that and check your national insurance record. While I'll be talking about the income that can be generated from a £100,000 pension pot, the reality is that the average pension pot in the UK is much different. So the numbers I will give you some context, but here are the typical averages according to Pension Bee data. So if we look at the average under 30, then the typical pot they have is £3,560. Those aged between 30 and 39, it's £10,126. Those aged between 40 and 49, typically they have a pension pot of £22,916 in total. And those aged between 50 and 59 have an average of around about £39,218. These are just averages. And there is a significant gender gap as well, which you would have seen on screen between men and women. Men typically have larger pension pots. And there's also regional differences in the UK. London and the South East tend to have higher averages as well. But this does give you some context and it hopefully encourages you to go and look at your own situation. But while your pension pot at the moment may be something like those averages, it's important to try and project that into the future to see what you might have at retirement and what kind of income you can generate from that. So we put links in the notes to some good pension calculators where you put in your current pension saving amount, how much you're putting in to your pension each month, maybe how much your employer is as well. And it will project what kind of pension pot you will have when you get to your retirement age and maybe what type of income you will get. When it comes to actually taking retirement income, that matters because that will influence the level of income you might receive. So typically, people with defined contribution pension pots might take their 25% tax-free lump sum. Now, they can do that from age 55 at the moment, but that will, of course, reduce the amount of money that they have to be able to derive an income in retirement. Now, some people might take that 25% tax-free cash and go into something called Drawdown with the rest of the pot. Now, that is used to generate an income that they need. Now, you have to bear in mind that that pot of money is still invested, so there is investment risk. So it does have the possibility that if you take too much income from it, that you might run out of money. Now, an alternative, I'm not going to get into too much detail about these. An alternative is UFPLUS, so UFPLS. That is the ability to, rather than take the tax-free cash up front, you could take lump sums from your pension directly over time. The lump sums each have 25% tax-free cash within them, and the rest of the lump sum that you take out is taxed as income. And then another option you have is to use your pension pot to buy an annuity, and that is a guaranteed income. The other options I've described so far do not provide a guaranteed income. The amount of income, though, depends on your age, your health, and the type of annuity that you buy. So to give you some real examples about income levels, if we're talking about drawdown, first of all, then probably the most famous rule out there is the 4% withdrawal rule. So that is where, as a guideline, you take 4% of your pot that is in drawdown in the first year as income. So from £100,000, that equates to £4,000. And each year after that, you increase the amount you're withdrawing by the rate of inflation to give you an income that will increase year after year. Now, realistically, according to research, that will probably only last you as a pot of money for 30 years. So after that period of time, you're likely to run out. And of course, the income isn't guaranteed in any way. There are other withdrawal rates you can use, other methods. So research that we've looked into in the past on the Money to Masses podcast, we'll put a link in the notes, suggests that a more sustainable rate is probably below 3% and heading towards 2% initially rather than that 4%. Vanguard have come up with some research and they've applied a dynamic strategy to withdrawal rates which flex according to the performance of investment markets. Again, we'll put links to where we've discussed that in the past. But annuities do provide a really good indicator of the type of income you might get from a £100,000 pension pot. So on the Money to the Masses website, we do provide an article where we update typical annuity rates. So for a male aged 65 who takes out a single annuity, so it's just for them, and it will pay this money until the day that they die, they can get approximately £7,500 a year. Now, if they change that annuity and add some features, for example, a 5-year guaranteed period, so if they die in the first 5 years, it will continue paying the income for at least 5 years, then that rate of initial income drops to £7,449. If they have a single annuity and they have that 5-year guarantee, but they also want the income to increase by 3% a year, so that's going to give them some kind of inflation proofing, then the initial income they can get from that annuity is £5,398, assuming they use £100,000 to purchase it. Now, another option is to take out a joint annuity. So, for example, a married couple might take out a joint annuity, which means the income produced from that annuity will carry on until the second death. Now, the amount of income will therefore be lower. It's £6,860 initially. That is without any inflation proofing. If you add a bit of inflation proofing, then the initial income drops to £4,895 for a £100,000 pension pot. So that gives you some indicators of the kind of income that you could get from 100 grand. Now, one important thing to point out, this isn't an either or scenario. So the drawdown scenario I mentioned, or annuities, you could do a bit of annuity and a bit of drawdown. You can combine the options to provide the retirement income that you really need. So some people might want an annuity, for example, to cover their bills. Now, you can boost your retirement income from the numbers I've just mentioned. So some of the strategies are, for example, deferring your state pension. If you do that, so you don't take it when you're first entitled to it, then you can get a higher amount each week. We'll put links in the notes to more information on that. You can, of course, fill the gaps in your national insurance record to try and make sure you get the full state pension. Now, there's an important date that's coming up, April 2025. Before that, you can fill the gaps in your national insurance by paying money going back as far as 2006. So therefore, you can boost your state pension. After that date, you will still be able to top up your state pension if there's any gaps in your national insurance record, but you can only go back 6 years. Now, other options that are available to you, of course, you could take less tax-free cash from your pension pot and use more of it to generate an income, but you also could increase your contributions before you get to retirement. Even small amounts make a huge difference, but also you can ensure that you maximize employer contributions. So take full advantage of them, and particularly if you're negotiating a new contract with a new employer, do make sure that you are maximizing the amount of money they can put into your pension. And another thing to bear in mind, costs are also important when it comes to the size of your pension pot when you get to retirement. If you can keep costs low, you will keep more of your pension pot to be able to buy the retirement income that you need. Perhaps most importantly, there is a way to boost the annuity rate that you can get at retirement with your pension pot. If you have a medical condition, you can perhaps take out what is known as an enhanced annuity. Now on screen, we're showing you a chart that shows you the amount of income you can get given certain medical conditions. So if you have a medical condition, because it may mean that you might not live as long, then the annuity rate that you get and ultimately the income you get from your pension pot is increased by the annuity provider. So just to give you an example, the no health annuity rate, that's the base one we're using here, was about £7,669 a year for a 100 grand pension pot. If you're a smoker, that actually goes up to £7,970 a year. If you are diabetic, it's £7,863. And if you are unfortunate enough to have had a stroke, then the amount of income you can get at age 65 is £9,426. Now, again, there are on screen, you can see the assumptions, but mainly it's you are a married man aged 65 with a wife that's 3 years younger and you live in an area which has an average life expectancy. Now, those numbers are significant, so make sure you look at enhanced annuities. And in fact, there's an amazing calculator and tool that Money Helper provide, which we put a link to in the notes, where you can go online and you can see the impact of your own medical conditions on a possible annuity rate and the amount of income you'll receive in retirement. And I even went on there and played about with it with Crohn's disease, which is what I suffer from. So do make sure you go and have a look at that. But overall, what this does emphasize is that when it gets to taking income from your pension pot, you must go and seek professional advice. There's a whole range of options open to you, which you can combine in different ways. There's advantages and disadvantages to each, which I haven't covered in detail. If you don't have a financial advisor that you trust at the moment, then we put links to an article on the Money to the Masses website, which can help you find one in your local area based upon customer reviews. So make sure you bookmark that, because seeking advice at this particular point in your retirement journey is crucial, can make a huge difference to the type of retirement that you ultimately have. And perhaps the most important message of this video is that if you found this useful, it's required a lot of research. Please do hit that like button and also consider subscribing to the channel. And also do leave any questions and comments below the video so we can answer them.